ask you, and I'll ask the audience, it's all one question. What's the kind of the pressing theme that has been, what's the common question that's been arising so far throughout all the presentations? Is there any one kind of general thing that people are either split on, or they all agree on, or disagree on?
Oh, that's a good question. A lot of questions about Palantir uh,
Oh, yeah.
throughout both days so far, which maybe I just pay attention to that because that's one of my, or disproportionately pay attention to that because that's one of my favorite stocks too.
Yeah. Okay.
Um, so yeah, a lot of people asking about that, and the indexes and gold, and you know, a lot of good questions so far.
Yeah. Yeah. Fantastic. Well, we can jump right in and kind of get started. I have it's interesting when you have been trading. So my background has been in the financial market since I was 19 years old. I started in this business as a teenager, and I have over the years managed a couple of different hedge funds, two different mutual funds. I've started three different investment companies, and I have been very active in the financial industry. I was president and on the executive board of the Dallas chapter of the Security Traders Association, as well as the Market Technicians Association. So I've been heavily involved. And when you are in this involved for many years, um, stuff just starts getting put in, piled up in your head, and you kind of forget to put it down on paper and be able to share and explain to others kind of what you're thinking and what's going on. And that's one reason why I love doing these sessions, is because then it makes me go through that exercise instead of just kind of all keeping it up here. So the markets are in a really unique place right now, as they seem always to be. But with the combination of where we are with interest rates, where we are with printing of money, the dynamics of Europe cutting rates and we're holding rates steady, and AI, oh boy, AI, anything that attaches the two letters AI to their name, it seems like gold right now. So there is lots going on. So I'm happy to address any questions you have about any specific stocks, but I do have my wheelhouse. Okay. And my wheelhouse evolves around option trading. I am an option trader. I have been since the 80s. I've been heavily involved in the options industry. And so, one thing about option traders, we not only have to be right in direction, but we have to be right in time. Okay. And that's what kind of gives option traders a little bit of a wink and a nod to saying, hey, you guys, if you're consistent and you're good, that's something special. And that's kind of where I've been for a long time. So let's kind of get into it. I have a chart of the S&P 500 up here, and we'll get into some individual stocks, but I wanted to show you a couple of things to orient you to how I look at stocks and how I chart. Now, I am a technical analyst, okay, so to speak. I'm a technical trader, and fundamentals I learned a long time ago. I have a soapbox set aside for that fundamental discussion, and I'm not going to hop on it today. But when it comes to trading, I am virtually pure technical. And when it comes to investing, okay, then I'll sprinkle in a little fundamental analysis, about 10%, maybe 15. It's a low number when it comes to analysis of a company or a stock, because people talk about overvalue or undervalue, and no, price is telling you where what the stock is worth. Okay, when two people come together and they agree on price, that's the value of the company. That's the value of the stock. So that's pretty much it. Okay, so looking at my chart here, we have a couple things going on. Now, the black line here that when I touch it, it turns red. That's just a long-term trend line that I have here. I'm going to do a couple things. So I have some moving averages on here. I have three moving averages that I use. One of them is common, and that would be the blue line. That's a 10-period moving average. But the red line and the gold moving averages are a little different. And I'm aware really only one other person that I discovered years ago uses these two along with me. And then there are probably very few others. And the red line is a 21 period moving average. Okay, 21 period. And the gold is a long-term 161 period moving average. All right, 161. And there are reasons why we use these. And you will see as we go through the charts how effective. In fact, let's go back and look at the S&P, and as it rallies up here, you can see pull back to the 21 period, pull back to the 21 period, pull back to the 21 period, and then chopping right around through it. Okay, and then you can see, let me zoom in here a little bit, coming right up to the 21 period, falling back off, gapping through it, moving higher. Okay, so many different stocks really respect that moving average along with the 161. Okay, so you'll see these two moving averages just so you know what they are. I also use Heikin-Ashi candles. So I use candles number one, okay, and then Heikin-Ashi candles number two. So let me throw those up here and let's talk about those for just a moment. If you ever have a question about trend or what's going on with the stock, you can. The great thing about Heikin-Ashi candles is that they provide a smoothing action to price. Okay, but there's an interesting dynamic about how to read the candles. Okay, so right now you can see as I zoom in on these. All right, these are big green candles with no wicks on the bottom. That indicates a big uptrend, big solid. Bulls are in control. Every time we get a little bit of we open lower, that is a buying opportunity for the market and market participants, and they're sending this market higher. Okay, now if we go back here a little bit, you'll see these big green candles once again, but then the bodies start getting a little smaller, and then we start getting wicks on the tops and bottoms. That indicates a potential, not guaranteed, a potential change in trend. Okay, so here we did have a slight, very temporary change in trend. Okay, and actually had a little bit momentum, and then the buyer stepped in. We got down to this 21 period moving average, and boom, back up we go. Okay, so I will often throw those up there just to get a sense of trend. And before we move into individual stocks, I'll give you my outlook on the S&P. Okay, I've got a target of 565 by October. Okay, just plain and simple. That's based upon some Fibonacci work and some time and price projections. Okay, and I can show you that here on this particular platform. Let me throw the Elliott wave projection. So we're in a fifth wave right now, heading higher. And then you can see out here what we call the tap box, time and price projection, and the middle of this box. So middle in between the upper and lower range, and the middle in time, which is horizontally here, is October 1st. Okay, and so that is a reasonable target. So that 560 to 565 range by October, that's kind of the target. We actually, if we keep up this momentum, we might get there a little sooner. All right. So we have so anyway, if you have questions about a different sector, a different market, let me know. I'll be happy to look at them. But that's kind of my target on the S&P for right now. And then let me talk about. I thought there was a couple things going on in the market that are very interesting right now and has not happened in, God, it seems like 25 years, and that is stock splits. Okay, so the big one in the news, obviously, right now, recently was NVIDIA. Okay, but there are a bunch of others, and you may or may not know about these. Now, a widely held stock that went through a stock split is Walmart. Okay, and so let's pull up Walmart. And you can see here, now this split occurred February 23rd. So I'll put my crosshairs back there and let's talk about stock splits. Okay, so here we are right here on February 23rd. And people have different thoughts on stock splits, but the commonality, the reality behind stock splits are that they they don't provide any additional value to the company. The value of the company remains the same. There's just more shares available, which provides more access to traders and investors at a more reasonable price. Okay, now Walmart went for a 3-for-1 stock split back here in February. Okay, so essentially for every one share you were holding, you now have 3 shares. All right, now what's interesting is of all the stock splits that are have happened and are going to happen, what's interesting is that they're all, they're all what I call easy stock splits. Walmart 3-for-1. Cooper, let's pull up Cooper here. Cooper Companies, they split 4-for-1 on February 16th. Okay, so February 16th, we'll go back here. Okay, February 16th, back in here. All right. Now, people think when a stock splits, that's automatic buy signal and jump on board. You can see on Cooper, this big gap right here, that's an earnings related gap. Okay. And the stock moved higher and then just dropped back down and traded sideways. Now, one thing that I find interesting here is you'll notice my scaling on the right, $95, 97 half, 100, 102 half. Okay, if I collapse that down to $5, okay, you can kind of see something that is common here, and that is a trading range begin. Okay, all right, so we have the low down here around 88, and then the high, well, and the gap kind of makes it a little wider, but you can see this trading range that we have here, okay, that effectively started back in late December, and this stock has been trading between, $88 and 103 to be specific, okay, so roughly $85 and $100 is where this stock has been trading sideways for 6 months. Okay, so really there's no added value for shareholders other than they have more shares. Okay, so that's the thing about stock splits. It doesn't necessarily mean an automatic bullish setup for a stock. Texas Pacific, they had a stock split on March 27th. Okay, so that was actually back here. Boy, look at that stock. The stock split, Texas Pacific went 3-for-1. Okay, and again, now it's a $750 stock. They might need to split again. And let me tell you, when you get on a bull like this, okay, this happened to me with a Potash Corporation years ago. The company's no longer around. They're still around, but not anything like they were back in the mid 2000s, early 2000s. Okay, but that stock split. Oh man, it was 6, 7, 8 times while we held it in one of our funds, and the stock just kept going up and up and up and up and up and up and up, and it was that's when you can really get maximum value on a stock. Okay, so not all these are household names, even though they're familiar names. They're not stocks that kind of come up every day. Old Dominion Freight Lines, they had a stock split on March 27th. Okay, so up here now you can see kind of they've gone, they split. Their stock went down to 220 approximately, and then now they're trading at 170. So it's not an automatic bid that runs into the stocks when they split. Okay, then you have NVIDIA, of course, that just split. Another one that's coming up now. This is the biggest one. Oh, NVIDIA was big. Okay, well, let's take a look at NVIDIA real quick. All right, so obviously this was a 10-for-1 split that just occurred. Okay, it looks like we have a little. When you see a spike like this in your chart, of course, that's a data issue, and that's coming from the exchanges. But ironically, that was the split date. Okay, when it first started trading. Okay, was June 10th. After the split, okay, and trading at roughly 120, 118, and now we're up at 133. So here's NVIDIA. It's more reasonable. It's in a sector that is hot right now. Lots of activity. This is part of the narrow market that people are talking about. Okay, so this is one that is a good bull. But a couple of other good names. Chipotle. Let's look at the stock right now, because it boy, this is one expensive stock. Okay, so it's at $3,410. And they're going to split. This is the biggest one, 50 for one. They're going to split 50 for one on June 25th. Okay, so it's upcoming, and that'll bring the stock down to about $68 based upon its current valuation, and make Chipotle kind of put it back in the game. We traded Chipotle for a while, and then it just got. I mean, just look at this chart, just unbelievable run that Chipotle has had. And some of you are probably aware of stock like this, okay, but many of you are focused on tech, okay, because it gets all the news, it gets all the talk, right? So and then Broadcom is coming up with a stock split. They are going to split 10 for one on July 12th. Okay, so here you have a $1,700 stock. Boy, look at the gaps. Boom, 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 and a vertical move. Let me tell you something about vertical moves. Okay. First of all, when you're looking at a chart and you are doing some analysis, all right, a move like this, okay, is ideal. Okay, that 45-degree angle, either up or down. Okay, awesome. Awesome move. It is when we go vertical, okay, or we drop significantly. Okay, this is where the problem starts. Okay, so when you get a move like this, okay, there is your angle of what we call angle of ascent, and that is unsustainable. It just is. Okay, we will get a pull. Doesn't mean we're going to get a bear market for a stock like Broadcom, but at some point we're going to get a pullback, and it has nothing to do with filling gaps or anything. It is that vertical move, and we see it time after time after time after time. These vertical moves just do not last. Okay, stock that's been in the move. I'll jump away from splits for just a second. GameStop is a perfect example. That vertical move is unsustainable, and it's been in the move news quite a bit. And then look at that, came right down to the 21 period moving average, and then vertical again, and then back down. Okay, it is anytime you see that vertical move, just if you want to participate in that bullish move, just wait. You'll have your opportunity. Okay, there's an old saying in the markets, and I'll kind of paraphrase this, that after a period of I'll think of it in just a moment, but what it has to do with is periods like this where we get these big moves. The stock will revisit the lows or the highs under normal trading. A good example of this is back, for those of you that remember, I think it was 2011 when we had the flash crash. Okay, and the S&P just dropped like crazy. Bid-ask spreads just went whoop. They went really wide on Spider. Okay, SPY, which they have penny wide spreads. They were dimes, nickels, quarters wide as the day went on. And then if you go back and look at the charts, you will see that we actually revisited those lows. Okay, if you remember, we dropped hard, and then within 2 days, we were back up to where we were trading after the flash crash. But then over the course of a couple of months, we were trading back down to those lows, and the bid-ask spreads were still pennies. Okay, so that's kind of an example of an old adage which kind of escapes me at the moment. But when you get these wild swings, okay, well, you're going to revisit where you were. Okay, and that's a good example. Okay, so we just touched on Broadcom. Williams Sonoma is going to have a stock split. They're coming up on July 8th. Okay, this is a $300 stock. Okay, Cintas, CTAS, they're going to have a stock split. That's coming up on September 11th. Interesting. They're going to have a stock split on September 11th. And then two more. Sony. All right, Sony will have a stock split. This is going to be 5 for 1. Interesting that that's an $80 stock and they're going to split 5 for 1. Interesting. I'll have to read more about that one. But that was on my list, on my research list. And the last one is Lamb Research. All right. And they are going to split 10 for 1. So obviously that's going to bring it down to $100, roughly 100, 108.50 based upon today's price, but that'll happen October 3rd. So it's interesting that we have these, and I'll pull up more data so you can see Lamb Research. I mean, obviously a good stuff. I mean, I don't need much technical analysis. I don't need to drape my charts in all sorts of analysis. I got 2 moving averages that are pointing up, actually 3. My long term, my 2 short terms are pointing up. Okay, I know what sector this is in. There's not much more I need. I might refine my analysis to try to determine price estimates because I'm an option trader and I need to determine price and time. All right. That is kind of the big thing. But what I'm really kind of, one of my specialties is in what we call delta neutral trading. Okay, making money from stocks that really they sometimes there's a couple strategies we use for stocks that really move, and sometimes we use strategies for stocks that don't go anywhere. All right. So before I get into that, is any questions about stock splits or anything? What I find interesting is that there's no odd. Back in the day, we would see 3 for 2 or 5 for 7. Really odd numbers, and all of these are just easy. These are easy. Okay, options will reflect the new values. You will see some odd option strikes on these splits, but you'll see more. There will be more strikes, and the key there is not volume, but open interest. If you want to trade around those, just look for a little open interest and check your bid-ask spreads, the width of your bid-ask spreads, and that'll help you determine whether or not you should be playing in that pool, so to speak. So if we don't have any questions about splits, it's pretty straightforward. Really, there's nothing that is too crazy about it. Let's talk about markets here again, and then that'll lead me down kind of another path. I'll get to earnings in just a moment because I love talking about earnings. All right. A couple of things that I find interesting are really the bond market right now. And I'll pull up the long end of the curve that I use, TLT, which is the iShares 20-year bond ETF. And if we pull up this chart, really this last move down, I was pretty concerned about, meaning interest rates are going up. Okay, now we've had this little relief rally, but if I zoom in on it here, okay, sorry, zoom in on it, we have not, prices have rallied, meaning rates have dropped. All right, but we've not gotten to this previous pivot up here. All right, now this is kind of interesting. Bonds usually are boring. We don't pay much attention to them, but these days I'm watching them very closely because of an anomaly that is in place where, although it's not talked about much, there is one guy talking about it, and that be Rick Santelli, who over at CNBC, okay, and he'll bring it up every now and then, but we don't need to kind of beat this to death, but it's something very important to watch on. So let me show you. That's the long end of the curve. The SHY is the ETF for the short end of the curve that I use. This is the iShares 1 to 3 year Treasury bond ETF, and I can probably remove that for now. And you'll see here that we rallied right up to the long period moving average, kind of hanging around this area of resistance. Now you'll notice here as I'll bring in kind of a horizontal line here, and we'll touch yesterday's close. Okay, so right there, and you can see how this line dissects all this pricing back here in March, February, March, and almost April. Okay, a little period of sideways action here. So this is an intermediate pivot here on rates. All right, but here's the point to this. All right, and I will introduce this chart to you. This is the 10-year, 3-month yield curve. All right, now this is what the Fed uses. They like looking at the 3-month, that's for their short-term rates, and then the 10-year for long-term. And we are trading now at, while rates have been coming down during this little relief rally, everybody's happy. Okay, I know there's some in the real estate industry. There's an interesting phenomenon happening, which I'll talk about in a second. But you can see we are inverted by 124 basis points. That's actually better than we were yesterday when we were inverted 131 basis points. But if you see this pivot back here in January, we're down at these levels, okay, in July of last year. At these levels is where we had bank failures in the regional bank sector. Okay, it really causes problems for the bankers, when this inverted yield curve starts getting wider and wider. So even though rates have been coming down, all right, we are seeing that this inverted yield curve is now increasing. When what this is causing is, like in big commercial real estate projects, what we're seeing is vendors, okay, essentially holding payments to their subcontractors. And the reason is they are essentially trying to earn the VIG by taking money and sticking it in 3 to 6 month CDs and making 5, 6, 7%, not quite 7, but 5 to 6% on their money, okay, before then they pass it through to their vendors. And the inverted yield curve historically has previewed every recession that we have faced here, okay? And it usually occurs 12 to 6 quarters, okay? So, or 2 to 6 quarters. So we're looking at anywhere from 3 months to 18 months, roughly, of forecasting. Now, this yield curve has been inverted for quite some time. It went inverted back here October of 22. Okay, this is a long drawn out process, and there's this problem as well as the amount of money that we're printing. What this can do is potentially be a problem down the road a little bit, something the Fed's watching. Okay, that's why they're being so stubborn on rates. I just heard a guy this morning just literally screaming at the Fed to cut, and I think that could be a little tricky right now. All right, so anyway, let's look at some individual stocks when it comes to names. Now, there are some hot industries. Tech obviously is one of those. I mean, you can look at individual names, or you can pull up sectors like XLK. Okay, and obviously these are like almost no brainer. You should be in this. You should be long and all this stuff. All right, but it's not as easy as that. Okay, now notice here again. I'll repeat it so you can watch it. Beautiful angle right here. Okay, beautiful angle. And what has happened here recently? Uh-oh. The angle has increased. Okay, not good, not good. And then I don't even need to put my hike and the she candles on, because I mean, obviously this is a big bullish trend here. And do you want to step in front of that? Well, how to trade this is really pretty easy. because the great thing is that when stocks fall, they do fall harder and faster than when they go up historically. All right. So how I would trade this is I'm okay maybe jumping in at any time, but I'm going to draw a line in the sand. Now, you could use a short-term moving average like the 10 period and say when it crosses that to the downside, I'm taking off my bullish trade or I'm going short, meaning I'm buying puts or doing a put spread or whatever whatever is your trade of choice. All right. But that is a kind of an easy call when they get moving like this. And you can then reverse your reverse your trade. And it is almost that easy, but you got to be watching. Okay. Not hourly or anything, but definitely day by day, just kind of keep an eye on it. And you'll see that the problem is you'll get this action right here. Okay. You'll get kind of a bullish candle. All right. And then the next day, which would be your trigger, you kind of get this action, and then all of a sudden you're ready to trade and you get a gap and the market takes off. Okay. And you maybe missed your opportunity. So anticipation is kind of key with some of these, but I would be kind of careful there. Now, an interesting thing. So technology obviously has been hot. Communication services. Now, in communication services, these are stocks that are very familiar, like Meta. Okay, Meta, doing very well. I mean, look at that move right there. But notice the kind of loss of momentum up here, and then we gap down. Now we rally back up. Okay, but all we're doing is we haven't even retested the highs yet. We're just kind of sitting right here at $500. That's a big round number. Hey, what are you going to do? But here's what I'm talking about. Here's my 10 period moving average. Okay. And I'm looking at separation here between the 10 and 21. That's good separation on the move higher if it holds here, and we exceed this previous closing pivot, which is right here at 508. Definitely looking to go long again on Meta if you're not in. Okay, if you're in, you're in good shape. If you're already holding this, looks good. Nothing to worry about. I can even put my Heiken Ashi on here, and this is the only thing that concerns me. Okay, you have this nice move up, and then what am I talking about? You get a little wicky. Okay, that's a Jeffrey term right there. Get a little wicky, and then all of a sudden, what are we going to do? I would keep an eye on this. So if you're in Meta, okay, as a trade, be ready to cover. Okay, if you're an investor and you're holding Meta, then what I would suggest, like if you're holding the stock, definitely sell a call against it or do a collar. Okay, sell call, buy put, and protect yourself. If when it starts dropping below those moving averages, is a definitely worth the investment if you're in that sort of situation. Obviously, in this sector is also Netflix. All right, so we'll pull up Netflix. All right, and I've left my Heiken Ashi candles on, and this is just a solid bull trend right now. I mean, look at the pricing though, big expensive stock. So Google is in this sector, Walt Disney, Fox, T-Mobile. T-Mobile, not very exciting. It's only up 10% so far this year. Okay, but it's in that sector. Okay, and looking okay. I'll put my regular candles on. If you guys aren't used to seeing Heiken Ashi, they might drive you nuts a little bit. But actually, after this drop here, this stock is holding on. All right. So that might be something to watch. Breaks above that 10 period moving average and eclipse $80. That could be off and running again for T-Mobile. Definitely one to watch there. A sector, though, that hasn't gotten a lot of love, but has been doing very well is is utilities. Now, here's the thing: when utilities pop up on your radar as a sector that's doing very well, that's a concern for the economy as a whole. Okay, I've seen it time and time and time again when utilities pop up as as a sector to watch. Now, a couple stocks here. We have Vista, BST. That's the best performer in the group. Okay, you can see they're having a little pullback. Now, this is what I'm talking about. Okay, these are regular candles, and you get this big red candle, and then you get your kind of confirming candle. Look at that, it holds right there at the 21 period. Now, though, it's still showing some weakness. Okay, it's not giving it up easy. I think this is right at an inflection point. Honestly, if I would draw a line in the sand right here, okay, off at this level, and say, this is my line in the sand. We close solidly below $85 because we're, that line's at $84.99. We close solidly below $85. That thing's going. That's going to pull back to this previous pivot right here. Okay, this previous pivot right here. This would be at $64. Okay, so there's your target. And I would say I would give that till probably mid-July to do that, because stocks drop faster than they run up historically. All right. But that's kind of my target there. The moving averages are both turning over, both long, my 21 period and my 10 period moving averages are pulling over and headed towards the downside. So, okay. So that's a sector. I'll give you a couple other names there. That was Vista, Constellation, CEG. Yeah, these are defensive. Okay, when you're in the utility sector, and it's one of the leading sectors year to date. Okay, these are defensive moves, and I'm finding that a lot of the traditional defensive mover stocks are not doing well, and I think that's something to be very careful with. It's for a variety of reasons, but when we look at defensive stocks, it's interesting. But utilities are holding their own, and so here we have Constellation Energy. Again, I would jump to my Heiken-Ashi to kind of look at possible trend, and I don't really see anything. It's holding up here at this 215 level. 200 is a big round number. That is your line in the sand. I would say to go short, okay, or to buy puts, sell calls, or whatever your strategy of choice is. But right now, this is you could effectively straddle this depending on several factors, checking implied volatility and pricing and all this stuff. And is there a catalyst for doing that, doing a strategy like that? All right. So, but this would be a kind of a good place that if the pricing is right, and I want about 10%, my pricing of my straddle, I want to be about 10% of price, really not more. I will do more, but if there's got to be a particular catalyst, and I'll talk about that in just a moment. All right. So really give yourself time. You need to go out to July, probably at least. Give yourself time for this stock to move. Let me pull up regular candles here, and you can see this stock does move. It's moving in a $27, $28 range, and you're right in the middle of it. So if you're more of a directional trader, see, a straddle is non-directional. You just want the stock to move. Okay, you want that stock to move. If you're convinced that Constellation is going to stay where it is, because it's been in this range since May. Okay, it popped up here in May and is trading in this $25 range since then. Okay, then you want to maybe do something that earns money from time decay, like a calendar spread or an iron condor or a butterfly or something like that, that as time goes on, you're making money because the stock's not moving. Okay, stocks do this 70% of the time. Okay, what's this I'm talking about? They move sideways. Okay, 70% of the time stocks move sideways, and it no matter, you can do the research. I challenge somebody the other about 6 months ago, and they did their own research, and they go, "Oh, geez, Jeff, the stocks move. We calculated over, and we analyzed 5,000 stocks, and they move sideways 69.7% of the time, 70%." Okay, so in fact, look at Constellation Energy. Look at this. Look at this move back here. Okay, 182 to 195. Look at that sideways action. Not doing much, not doing much. Oh, bing, boom, rally up, new level, trade sideways. Okay. So it's just, it happens time and time and time and time again. All right. So, all right, we did have candles up. Okay, good. All right. So, so speaking of straddles and strangles, let's talk about this a little bit and put it into context. So this is a strategy that you guys learn early on in your, if you're option trader, you learn it early. Okay. And then maybe you tried it a couple times and it just didn't work out. I'm going to tell you why. All right. You were incorrect on price movement, and you were incorrect on implied volatility. Okay. Those two reasons. And then you give up on the strategy. It is a viable strategy. It's actually a very good strategy to use, but on the right stock. I'm going to show you those stocks, some of those stocks. Okay. So again, if there's questions popping up, feel free to interrupt me. I'll be happy to address them. But let's look at some of these, and I'll show you a couple that I just took off in a service I run called Delta Neutral Breakout. Okay, and these target stocks specifically on their potential to move and their pricing. Okay, and it surrounds an earnings event. It surrounds an event. Okay, and that's the key. That is the key. Okay, so recently, let's take a look at a couple of these. Oracle. Okay. All right. Now you say, oh yeah, no brainer. What sector is Oracle in? Blah blah blah. Okay. Well, here is the move. Okay, on Oracle. Now, this stock did what we kind of thought it would. This stock, we were priced. The options were priced for about a 9 to 10% move, and this move right here is about almost 14%. Okay, so a straddle in that case would have been ideal, and it was, because that's what we traded. Okay, was a straddle on this going into that earnings event. Yes, implied volatility was high, but we found the edge in the option pricing. Okay, and boom, stock moves higher. And if you, depending on how much time you had in your options, look at this. There's follow through. It took a couple days, but now, man, boom, up, trading at 144, and it was just trading at close the other day around 123. That's a substantial move, and that was all done through a straddle or a strangle. Those are the two strategies: straddle or strangle. Guess what? Those two strategies don't involve selling premium at all. So you're not doing spreads or anything, just buy, call, buy, put, buy, call, buy, put. Sometimes we do it at the same strike with the same expiration. Sometimes we do it at different strikes with with the same expiration. Always the same expiration, but possibly different strikes. So we did a strangle on this, and boom, rallied right up. Now, really, any stock, any company that is attached AI is a potential candidate right now. Okay, they attach AI, and they're involved in that space. Now, here's the thing: if you want to trade NVIDIA, do this strategy on NVIDIA, for example. Okay, now before split, I can tell you the straddle on NVIDIA, the last time I priced it out was $28,000. $28,000. Now, the split allows us to reevaluate and possibly include NVIDIA in our strategy, okay? Because there is a certain amount of risk that we want to take, that we want to be effective to manage risk and still earn a nice potential reward that does positively impact our portfolio. Okay, now a stock that you might not be aware of, okay, because this happens on all sorts of stock. Oops, sorry, wrong one. Restoration Hardware, RH. They changed their name to RH. Okay, RH. I like Restoration Hardware as far as the name goes, but It's kind of like Federal Express changing it to FedEx. You just got, it takes a little time to get used to it. All right. So the stock gap down 17% on earnings. Okay. And look at this, more follow through to the downside. This was incredibly profitable for us on that move, but this is the catalyst that you need. See that big gap? That's the catalyst that you need to make a strategy like a straddle or strangle work for you. Okay. Now, let's say you're looking at this and you missed that trade. Okay. What do you do now? Well, I can tell you by looking at this chart, and you can sprinkle other things on here. Let me see if I'm not much of let's see here. Like volume. If you like tracking volume, okay, notice the volume spike here, big spike. Okay, look at the volume spike back here. What do you think that was? What do you think this move was from here to up here? Okay, on that move, that was a jump of 17%. Okay. Oh, guess what? That was earnings. All right. So RH is a stock that, guess what, is on our radar. Okay. It is a stock we like to trade around these earnings events with the right strategy. Okay. And the right strategy right now is a straddle or a strangle as a basic strategy. All right. And believe it or not, you want to know another good one? Okay. Foot Locker. Okay. Who knew? Shoes. Okay. Who knew? Okay. Now look at this. Look at this candle right here. Notice the wick. That is not a data error right there. Okay. Let me zoom in on that. This is not a data error. This stock gapped up, ran up to 29. What was the high there? 29.72, and then traded down all day. Now I tried to revisit that price over the next 2 days, but couldn't quite get up there before giving up the ghost and refilling the gap here. Okay, now before you guys start going in the back of your mind, oh, gaps always fill. Gaps always fill. Well, yes and no. Okay, gaps don't always fill. All right, and my question to you is when will the gap fill? Okay, because as you saw, I kind of gave it up already. Look at this gap down here. Guess what that was? That was earnings event. Okay, what do you know? Okay, that earnings event for Foot Locker was, let's just say, going from $34 and closing down at $24 is that's a significant move for Foot Locker. All right. So in fact, let me just get that exact. That was a 30% mover. That was a nice trade previously. So nice trade back in March, and then nice little trade here in early June again. Okay, that's Foot Locker. And a really good one is TripAdvisor. Okay, so again, these are stocks in different sectors. Look at this move here in early May. All right, that was a drop. It closed down 28%, but it traded lower. I mean, it was down almost 30% on the day. I was going to tell you how to trade RH. Let me go back to RH real quick. Okay, that volume spike. Okay, so this volume spike. Let me zoom in on this and let me take off the volume. Okay, all right. So now we see the volume spike day obviously was earnings. And now we saw a candle that, as you notice here, it barely closed in the middle of this previous candle. That indicates some continued weakness. And now today we're trading lower. Okay. This would be a decent short, meaning buy puts, do a put spread, do an out of the money calendar spread down below it, do butterfly down below it, maybe target $200. Okay, it's at 223 right now. Maybe this big round number of $200. That would be where my target is. Let's go back in time. Look at this. this previous low pivot right here. All right, right there. Boom. Okay, well, that's the first stop, 213. But I think it might try to target that 200 this time. But I might do a trade down at 215, like an out of the money calendar spread down there, or I could buy the 220s and sell the 215 puts and do a bear put spread. Okay, so buying the put spread as it trades downward, and then you got a good trade there. Okay, but a lot of these stocks, they're just not in the news and they're not well known right here. Here's Roblox. Okay, RBLX. Look at that. Look at that move right there. I mean, this gap down that you see, that is the earnings event. That was traded down 22%, okay, on the day. And we got good value in the options. Option market makers were looking at a 12% move, and it moved 22%. So that's kind of the story there. The previous earnings was a good one, but not quite as good. This is back here in February. Okay, this move was a little over 10%. It actually traded about 12, 13% higher and then pulled back throughout the day. But what's the overall trend here? Okay, the overall trend is down. Okay, lower highs and lower lows. Okay, lower highs and lower lows. So now that we've rallied up, filled this gap, what do you think the next move is? Okay, if I showed this chart, I can tell you, because I've done it to a 6-year-old and showed them, drew out the pattern with a marker, they would tell me the next move is down, and you would not believe how right they are majority of the time. Okay, until this stock proves me wrong, that would be the play here. Maybe targeting something down at 32.5 or $30. Okay, even though it's not an earnings play. Okay, but these earnings plays lead us up to other potential trades. Okay, because of these moves. You can see here about the gap. Okay, this time, look at this. The day after the move, looking closely here at the candles, day after the move, we traded up. This is the day right here, about 3 days. I would give it 5 days to tell me which direction are you going to move. Okay, and it's this candle right here on May 14th that we would do either a bull call spread, an out of the money calendar, maybe a bull call spread or something. And you can see the stock moves up and then just trickles up on higher. You just got to give yourself time to be right. Now I'm waiting for a signal to go short. And that's the way I'm leaning. Okay. Kind of like the goalkeeper kind of leans towards where they're thinking. Sometimes they make the save, sometimes they don't. Okay. But I'm going to let this stock tell me where it's going. Now, and last one, as far as movers, okay, I've showed you a bunch, and there's a bunch more. And again, they're not names that you normally think about. Penn National Gaming here. This is, or it's now Penn Entertainment. But this was a okay winner. Now the earnings event was right here on this candle here, and you can see the wick on the bottom. This thing just started trading lower, and it looked like an ugly day. Okay, but the stock did catch a bid and started to rally higher, and then you can see it just kind of trickling sideways, not really doing much. Look at this trading range here. Well, it popped out of this $2 range here, and it's trading a little higher now. But man, look how quiet this stock is. Okay, historically, just not doing much for those investors that have money in here, especially if it's not, I mean, dividends. Don't get me started on dividends, but it just not providing any value for the investors, for the shareholders. But for option traders, we can actually do a lot with this. So for all of these, okay, there are also stocks that just don't move around earnings. Okay, and we also look at these. We look for stocks that historically they go through earnings, they're well established, They just don't do much. And let me show you a couple of these. We do different strategies for these. Okay. So DocuSign is an example. Okay. On DocuSign now, it looks like this stock just is a big mover. Okay. But I'll show you what it did around earnings. Earnings date, okay, was right here, this candle right here. Okay. Just about a week ago. All right. Now the options allowed us to sell premium going into the earnings. The strategy we used was an iron condor. Okay. The stock moved roughly 5 to 6%. With the break evens in our iron condor were at 12%. Okay. They were at 12. We were allowing for a 12% move. And we sold premium because there's high implied volatility. We get great value for selling that premium. And the stock only moved 6%. Moved a little bit more during the day, but you can see it caught a bid, rallied. It was only down 6%. That was a good trade for what we call quiet earnings. Okay. Zoom here is another stock. Now you can see after the earnings event, it caught a bid, but believe it or not, guess where earnings were on this? May 20th, right here. Okay. This was earnings. So this candle right here, this green candle right here was the day after earnings. And look what the stock, look at my scaling over here. It's in 50-cent increments. Looks like it. Wow, look at all that volatility. Well, let me put this into $5 scales. Why? Because that is where we can place a lot of these strategies. We can make it $5 apart or $2.50 apart. But look how just did not move. Now here recently, the stock has moved down. Okay, but look at my scaling here. It's in $2.50 now sections, and it looks like there's a lot of volatility with this. But the earnings event was right here on this candle. The stock just didn't move. We get out the day after because implied volatility crushes, meaning it loses, all those options lose their value. And that is how we lock in our profit. We sell it for higher, buy it back for lower. That's how we make money on these, what we call quiet stocks that just are not moving. Okay. Guess who else is like this? Okay. Home Depot. All right. You would think. Now, earnings for Home Depot, again, you're looking at the latest data here, and it looks like, oh my God, this stock gapped around and everything. But where was earnings? Earnings was right here. Oops, sorry, on this green candle right here that dropped a little bit. Okay, but our break evens were about 350 on the top and about 328, 325 on the bottom. And look at this. This stayed right in the middle of our trade, and we were able to sell premium, capture that premium for very little risk. We don't do anything what we call naked. We don't sell naked options. We hedge everything off with long options. Okay. But these earning strategies are stuff that we do in the two services I provide, which is delta neutral income, because I generate income off of these, and delta neutral breakout, okay, which looks for those stocks that are popping. Now, what happens if things go wrong? Okay, and sometimes, yeah, but let me show you an example of something that of this. Okay, Aflac. Okay, our latest trade on Aflac just wasn't all we expected it to be. Earnings were back here on what's that date? May 1st. Okay, May 1st. Let's go back to May 1st. Okay, this green candle, oops, sorry, this big green candle right here. Okay, and Aflac just didn't move. Okay, on that candle. But look at the last earnings. Okay, in early February, big gap down. Look at the we can go back earnings on this back here, and I'm looking right here. If you can't see my mouse, let me put that circle and I'll drag it. Okay, right in there. This green bar right here was the earnings event, but look at this move that we got all going into earnings, started profiting, then this big candle. So Aflac is historically a mover. What will happen with these stocks is that typically, if you look and you do your analysis and you look at the charts, 1 out of every 4 could be challenging. But what we try to do is refine it to where it's 1 out of 6, 1 out of 7, even 1 out of 8 we find challenging. So this last one, hey, we took a little bit of a loss on it. No big deal, because we have profited on all these trades before. So this is where earnings is our catalyst for these types of trades, and deciding whether you're going to buy premium and do a straddle or strangle, or sell premium by doing a different strategy, is how we is where we provide our value. So with that said, I'm going to wrap it up. What I want to do is drop a link for you, because I have a guide that I want to give you for attending today, and it talks about our breakout strategy and how we find and how we analyze and how we trade these stocks. And that link is ewotrader.com/straddle. Okay, ewotrader.com/straddle. And if I didn't tell you, I'm the senior investment strategist over at EWO. Okay, EWO stands for Elliott Wave Options, because we do use Elliott Wave in some of our analysis. Okay, and that is how I got my spider projections, is off that analysis. But with that, I will turn it back over to David, and if we have any questions there, just let me know and we can wrap it up.